What's up? I'm Dan Fredenberg, and this is another Chance Encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. I'm joined today by Denver. How are you doing today, Denver?
I'm doing great, Dan. How are you?
I'm fantastic because after all, I don't know if you realize this, but my very favorite member of the audience is watching right now. And why is my favorite audience member watching? Well, it's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors. That means passive investors. It means operators. There's lots of people like that. And you may ask, why would you do that? And the answer is, if you've ever heard of an off-market deal, a private deal, the type that you're not really allowed to talk about, they're sometimes called 506B syndications, well, you need to have documentation of your prior substantive relationship, or else the SEC will get ants in its pants, and we definitely don't want that. But the benefit to you is you'll learn how to effectively communicate on the subject of commercial real estate, and you'll also learn how my guest fits into those deals. But before we get talking too much about deals, Denver, do you want to say a thing or two about yourself?
Yeah, absolutely. So for me, definitely ventures outside the realm of real estate, but definitely still in the realm of making money and return on investment here. So I think we're all in the same boat, just different shapes at the end of the day.
Mm-hmm.
So for me, parents and I, we got into RV park investing. For me, I worked in private equity and helped other bigger investors find bigger deals in the boring business space. So all those all those businesses that really bring down the room at Thanksgiving, those are the ones I love because they're great cash flow, great entry point, and great for growth and exit at the end of the day.
I love it. I love it. And of course, I didn't get to the right slide first. I got to say, but wait, check your eight. Denver, you're on the younger side, so I don't know if you have the technological inclination to be able to see through the camera and into the user's device down there, but there might be this hideous subscribe button, and I think it's just plain embarrassing. They should probably do something about that. Okay,
They probably should subscribe, right?
Right, exactly. Smash that button. But jokes aside, I've now spoken to thousands, perhaps, of different players in commercial real estate and the real estate space, and everybody has their own unique why. But I found that they fit pretty neatly into these 5 different categories, and we need to know what the motivation of somebody in real estate is, because after all, these deals, they take months to close, they take years to go full cycle, and so there has to be something to make you stick around, not throw in the towel. The 5 motivations that I find work really, really well to describe what people, where they're coming from. The first one is preservation of purchasing power. What's that? Well, some people, they don't have a W-2, they don't have a job, a full-time job, but the way that they pay their bills is from the proceeds of the assets that they own. In other words, their portfolio. And if you're in that situation where you are work optional, it doesn't really make a whole lot of sense to be putting months into a brand new deal. So the question might come, why would you bother? And there are a few scenarios. One of them is if inflation is rearing its ugly head, it might take a dent out of the purchasing power of your cash flow. So it'd be time to make a new acquisition. The other one is when you can buy at a steep discount due to an asset crash or general distress. Now, this is not really where I'm at in my real estate journey. What I'm up to is trading time directly for wealth. And what that's all about, my background is in technology, and when you are a high income earner, high salary earner, you're going to be paying more in tax than anybody else. Me personally, it was the CRM industry, so online transactions and making the web assets, the different funnels and things like that for people and sending out millions of emails per month. But starting in 2014, I started to do that for a guy who was doing 10 single family family house transactions a month. So flipping 10 houses a month would be a simpler way of putting it, slightly less accurate. But he was making all this money and his tax burden was a lot lower. So I started thinking, how can I pivot to where I'm getting rewarded instead of high salary in little slivers of equity here and there? So that's what I'm up to. But some people, especially most youngsters that I run into, they're more interested in taking control of their schedule. And that might mean hustling like crazy now so that they can retire early. But sometimes it's more like they just want to work fewer months per year or fewer weeks per month or something like that, which is a perfectly decent motivation. Some people who believe that, they think it's everybody's secret motivation, but I assure you that's simply not true. For example, there's the ambitious ones among us who want to just buy their entire hometown. They have to have their name in lights or in a huge sign on a business or a building or something like that. And the beauty of having somebody like that on your team is they're going to hustle into their 90s. So they're always going to stick around, and you have to have people like that on your team without a doubt. But that's also not everybody. Some people, they're equally motivated to work into their 90s, but they've picked a sector of society, or maybe it's the environment or animals, who knows what it is, but there's a big financial component to making a real big impact on the world. And so that's why some people are making their commercial real estate acquisitions. So Denver, of those 5 different motivations, what combination of those would you say describes you best?
I am absolutely the person that's going to be working until their 90s. I mean, I may take some days off for golf when I'm in my 90s, but yeah, I don't know what it is about at least grinding harder and harder every day, but that's just ingrained in my blood here
Mm-hmm.
because I don't know what other people do during the day. Like, so I've had multiple jobs and do full-time college, graduate a couple years ago, and now still my W-2 in the PM and then still work on my business during the AM. And it doesn't really stop me for anything, really.
Mm-hmm.
And I don't know if that work ethic's gonna get me all the way to 90, but I sure hope it does, or I'll work myself until I croak before 90. But either way, I'm not going down without a fight. That's kind of more my mentality at the
I
end of the
love
day
it.
for everything I do.
I love it. I love it. And that's one of the best things about this industry is the positivity. But at the same time, there are risks involved in every type of business or investment. And if you've ever been involved in a 506B syndication, these private off-market deals, the securities attorney in the mix should have forced everybody involved to fill out this suitability questionnaire, is sometimes called, but it's a financial questionnaire asking all sorts of questions that are usually quite uncomfortable to answer. But when I was filling one of those out, a few of them actually, I noticed that the tolerance for risk question, it didn't really give me what I'd call actionable information. So for this interview, I made my own one. It's a fill in the blanks question. There are many popular investment asset classes, but I think blank is too risky. Denver, it can be inside real estate or outside real estate. What's too risky for you?
I mean, so as far as putting a certain niche or genre in a bracket, I don't love that because a lot of people are educated in different fields that are well beyond my knowledge, well beyond yours and everybody else's. And the thing is, I feel like the one that's going to be the riskiest is the one that you have not a single clue about. So if you know nothing about Pokemon cards or crypto, I'm not saying anything like that. I'm not saying, what is it? I have people live my flat who have tons of Pokemon cards and know way more than me. Okay. And I bet they can crush it. I had a friend who paid their college loans off from Dogecoin. Now, I'm not saying do any of that, but I'm saying the things that you are the most educated in are the less risky, the least risky, and the ones you're least educated in are probably the most. So, and that can change how you educate yourself. That can change how you choose to directly learn or specifically learn in a specific skill set.
Mm-hmm.
So, what was it? A
That's
gentleman I work with in my W-2 job. He just started reading Rich Dad Poor Dad, and I was like, I love that. And he starts
mm-hmm.
getting into real estate. So real estate's risky for him before he starts learning about real estate and becomes less and less risky the more you educate yourself.
I love that. I love that. And of course, like when it comes to Pokemon and cards, my biggest complaint is it's an appreciation move. You know, buy low, sell high, or lose. And you need a few more plays than that to make commercial real estate work. And on that subject, I know that some people who get into this industry, they're more on the public relations side or the marketing side. They're not the spreadsheet junkies who are up to their eyeballs in these numbers. If you are one of the spreadsheet junkies, every single metric is going to be important with very few exceptions. And even if you are the PR person rather than the person who's signing on the loan for these $5 to $10 million buildings and up, you're still going to have a few different numbers that you focus in on to figure out which deal makes more sense. And for anybody in the audience who is listening and not watching, I'm going to read out the 14 different ones that I have on here. The first one's cash on cash, then IRR, cost per door, net operating income, going in cap rate, which really means the difference between the cap rate you're buying at versus typical properties in that area. Then there's the loan interest rate, especially if you're going to be assuming a loan. Then there's the occupancy or the vacancy rate. It's inverse, basically how many units are filled. Average income, where the property is located, amortization period of the loan, the difference between the market versus the in-place rent, the population growth where the property is located, so you have some baked-in appreciation right there. The sponsorship record, in other words, how many deals have already gone full cycle, how many are on the go right now. Then the waterfall split exit strategy, in other words, what's going to happen after your capital is returned to you. And the last one I have up here, even though there's more that some people can say, it's the DSCR, which is debt service coverage ratio. In other words, how much of the income of the property is going out the door immediately just to pay for the loan. So Denver, maybe you want to do like a top three or something like that, but which of these metrics really sing to you?
Yeah, absolutely. So I am 28 years old. So I like to say that I like risk more than my parents do because they're twice my age. So depending on where you are in your life, these things here may differ for you in higher priority or less priority. So for me, at a young age, I'll give you young, middle, old in top three in those. So 28 years old right now. I want to see cash on cash return. I want some more short term growth for, long term gain to leverage somewhere else. So I definitely, cash on cash return, interest rate, and NOI. I need those three things when I'm, at my beginning stage to grow my portfolio later on and not have such a long term outlook. Now, let's say I'm somewhere in the middle here. Going cap rate is going to be really important to see how good of a deal it is or how, much of a discount or premium you're paying for it. And then interest is always going to be a big thing. And then I guess acquisition cost per door. And then say I am on the later ends of my life here. The waterfall split, the exit is going to be really important and how safe the deal is. So the DSCR ratio is going to probably be a good indicator how safe the deal is going to be. And then I guess the sponsor record, so how well they do in that industry. So I'm being much less risk averse than other people are in my later years because I want more of a guarantee when I'm very old, and I want more of a higher leverage return when I'm very young and somewhere in the middle.
I love it. I'm eating that answer up like a beautiful subscribe sandwich, which is the very subtle reminder that it's time to pull out the Dan Does Deals commercial core competency cube with the 6 different key roles in a commercial real estate deal. And if you're looking at this and saying, wow, I really need one of those, well, they happen to be free. You can go to dandoesdeals.com. There's a great big button. You can print and download it. And just so that you know why I'm giving it away for free, I'm not even asking for your email address, which that's the cardinal sin of marketing. You never give away your freebie without asking for some sort of contact information. But I realize that commercial real estate is one of those things where your ability to effectively communicate is going to dictate your success in this industry. So in every episode, I go through all 6 sides, explain what they are, and then that way, not only do you learn how to effectively communicate, but you also will understand better how my guest fits into those deals. So let's go through them. The first one's the repositioner, who's an acquisitions person. They look at a bunch of different deals. They do a bunch of different paperwork. Why do they have to do paperwork? Well, their fancy word for what they're doing is they're underwriting the deal, which means they're figuring out, is this property even making the amount of money that the seller/broker is claiming it is? Because, and of course, they have to figure out how can they find upside. Now, the most unintuitive side of being an effective repositioner is you have to have a wide variety of relationships with financiers. So that's different lenders, basically people who deal with paper and money, and the people who run the business. They do not deal with the residents or any of that hassle. And the whole idea is that if a repositioner has a great relationship with some financiers, they might be able to secure a more advantageous loan, which goes straight to the profitability of the property. So that's why that's important, and that's why they're spending so much time with them. But the next thing that a repositioner is going to do is they're going to figure out, how do we stop all these Benjamins from going down the toilet? That's operations. Of course, there's more to operations than just unclogging toilets and collecting rents and mowing lawns, shoveling snow if you're up where I am. And the contribution that I end up bringing to operations as an asset management role is between the digitization of all the computer-based tech stuff that I do, but also if you understand that vacancy is the enemy in real estate, you need to have somebody on your GP team that has some serious marketing chops, because you need to get those units filled. Even if you are outsourcing to a third-party property management company, that's if they're dropping the ball as far as vacancy rate, somebody on the GP team has to step in and get those units filled. But of course, that's not enough upside for most deals, or a lot of deals, and some repositioners, they need to force the appreciation a lot more. The way you force the appreciation often is by getting a contractor team involved to make the place nicer. That way the future residents are happy to pay more in rent than the previous one because it's nicer. But you can spend endless amounts of money on contractors and not actually get a return on investment. Just like if you gold plate all the toilets. It's not really going to work out the way you think it will. But keeping an eye on the contractors is very, very important, to make sure that they're keeping to schedule and they're not using subpar materials. And if you're like me, I don't know if you know this about me, but I'm from the internet. So that means I rely on locals, boots on the ground, people who can be there in an hour or two, because that will not be me. I'd still be stuck at an airport in an hour or two. So I need to rely on somebody who can be there and keep an eye on the contractors and keep an eye on the operations, make sure that you're not getting snowed. But let's say you become a repositioner. You're an engineer or a physician or an attorney or something like that, and you see, let's say, a 350-unit apartment complex down the street, and you say, hey, I know how to buy a house. So what if instead my friends and I, we pool our resources, maybe put in like $100K each or something, and we take over that property down the road that's a 350-unit apartment complex. Well, when you turn around to the bank and say, hey, this apartment complex is, say, 350 units and it's tens of millions of dollars, you don't have, I don't know, tens of millions of dollars you want to lend us, do you? Well, one thing that I haven't discussed yet, and it's going to dictate whether you're eligible for the commercial loan or not, is something that they gloss over very seriously in a lot of guru and mentorship programs, and you must know this, so listen carefully. They're going to ask, who's your sponsor? Who's the KP? Who's the key principal involved in this deal? See, you're not eligible for a commercial loan unless somebody in the fold already owns a similar asset, because that way they can demonstrate that they're not going to run the property into the ground. On top of that, of needing that sponsor, you need a certain amount of liquidity, and then amongst the entire GP team, you need a balance sheet of at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So Denver, I understand some of your repositioner roles, some of your financier roles. Of course, there's going to be the operations, asset management, things like that. But I don't want to put words in your mouth. Which sides of the die do you expect to contribute to your next deal?
So for me, I primarily have worked in more the acquisition side and finding the right deals. So, I run the numbers, have tons of lovely Excel models that, I love to share, that are far from exciting, but, really qualify the deals. So my space isn't really in real estate. It's more in private equity and boring businesses. And so I find specifically accounting firms. So accounting firms with a good deal at 50% profitability rate, those ones I kind of like. And then, I do work on tying it all together too right now. So I'm interviewing a ton of CPAs for an operator role. And yeah, I think I'm juggling all the roles right now. However, the acquisition side's where I definitely have the most strengths in, so I can really spot out a good deal.
Sweet.
Don't a lot of
Sweet.
others.
Awesome. So we really need to wrap up, unfortunately, but as far as the buy box goes, the buy box is usually the geography, so which states, the size, so the size of the property, sometimes by unit count, and then the third one's desirability, and the desirability is split into the condition of the building, so how nice is it, and then the area where the building is located. In other words, the crime rate, where it's located, the school districts are going to be important if it's multifamily, and then of course the amount of traffic that goes by. But both of those definitions of desirability are ranked the same way as grade school, where you have A plus at the top, and then A, and then A minus, and so on like that. So as far as a buy box go, Denver, what's easier to say yes to?
I would definitely say, I don't know, I'd say like maybe that B class neighborhood definitely is always going to be that bread and butter. A class, I feel like they don't perform as well as others, or it's more of a long-term play. And then that the lower the class go, the more shorter term or better cap rate you're going to get. And then the better the neighborhood, the lower the cash flow, but better, long-term appreciation you're going to get from it. So it really depends on where you're at. I'm really young. I may invest in those D class neighborhoods to get some quick cash flow and pay off the loan quickly, and then leverage that to a C, B, and so on and so forth. So that's kind of my take on it.
All right, great. And then as far as people who you're eager to speak to, me personally, because of where I am, I'm always eager to speak to more sponsors and KPs. Denver, are you more looking for financiers or the deal sponsors, or what is it?
So currently I'm looking for everything. So I'm looking for capital for our next accounting firm acquisition, next CPA to operate it with some equity on the table for him or her, and then some lenders to really get the ball rolling here. So currently this week it's tying all those strings together to find the right fit for everybody. And then once that's done, then we find the deal, which doesn't take too long for me because that's kind of more my strong suit.
Excellent, excellent. And then the next question is how to reach out. Me personally, I'm easy to find, especially on LinkedIn, which is where I spend most of my time. And if you do have your phone handy and you scan this code, however, that brings you to the FAQs page of 506BME, which is the platform where I offer to help you with the IT and backups and all that sort of fun compliance stuff for 506B deals, so that if you drop your laptop into the bathtub and the SEC audits you, you still have all of that documentation in place. But Denver, if people want to reach out to you, what are the best ways?
So you reach out to me on LinkedIn or just, shoot me an email. It's just denverlincoln@gmail.com. So Denver, capital Colorado, the president, gmail.com.
Beautiful.
First one to get it, so it worked out well.
Sweet, sweet. And the last thing is the public service announcement. It's actually not for you, Denver. It's for you in the audience. If you've been watching this episode and experiencing searing pains in your eyeballs, maybe like migraine-like symptoms, I'm really confident it's because of the hideous subscribe button that's down there. And it's free to get rid of it. You just click on it. At full disclosure, I want people to click on it because if enough people do, then YouTube will actually start to pay for these videos instead of me. And I think that would be amazing. And the trade-off, just so you know, is that my videos may show up on your list of suggestions, but you can go ahead and ignore those suggestions. I just sincerely appreciate the fact that you spent this time with me. Just like Denver, I appreciate you joining me. This has been great.
Hey, thanks for your time, Dan. Appreciate it.
Awesome. Thanks. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, and all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay, are you already logged into 506B me?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506B me, everybody.